C3.ai and UiPath both utilize artificial intelligence to help enterprises improve performance. That being said, UiPath and C3.ai have experienced almost opposite directions in their stock price performance in 2024. C3.ai stock is up almost 50% year to date, while UiPath stock is down almost 50% year to date, both experiencing moves in opposite directions. But what about for 2025? Which one of these stocks is the better buy for 2025? That's the question I'm going to answer in this video, comparing these two on revenue growth, on cash flow from operations to sales, on operating profitability, and finally comparing them on valuation using the forward price to sales ratio to determine which one I think is the better investment for 2025. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So like I highlighted in the introduction of the video, look at the share price performance of C3.ai and UiPath. While they started the year on a similar trajectory all the way until April of this year, the performance separated at that point in time. You can see that big difference here. UiPath stock falling and C3.ai stock rising, and that separation sustained throughout the year. And in the last month and a half or so, that separation widened, with C3.ai delivering 49% return year to date and UiPath down 44% year to date. So to look for the 2025 answer, let's start by comparing these two on revenue growth. And on that metric, C3.ai has delivered better performance. They both accelerated revenue growth in 2023, but UiPath experienced a turnaround going downward in 2024, while C3.ai, its revenue growth increased and accelerated to 29%. That's the primary reason why C3.ai stock has outperformed UiPath, is the accelerating revenue growth compared to the decelerating revenue growth for UiPath. However, when we compare these two on cash flow from operations to sales, UiPath demonstrates improvements that are better than C3.ai. C3.ai, with negative 14% cash flow from operations to sales, is about at the same level it was at in 2021, while UiPath from 2021, where its cash flow from operations to sales was around 5%, has improved that metric all the way up to 23% in the most recent trailing 12-month period. That means the company is generating more cash flow out of each dollar in sales, while C3.ai is still losing cash flow from each dollar in sales on a trailing 12-month period. Although the company did deliver positive cash flow from operations in its latest quarter, and management is forecasting continued improvement, sustainably achieving positive cash flow from operations going forward. So that's something that C3.ai stock investors have to look forward to. UiPath management said something similar. They forecasted cash flow from operations in the upcoming fiscal year to accelerate. That means not only increase, but increase at an increasing rate, which is also great for UiPath because that's coming from an already elevated level, whereas C3.ai is improving cash flow, but from a much lower level than UiPath. And we get a similar story when we look at the operating profit margin. UiPath much better than C3.ai with negative 13% and improving quickly. C3.ai only recently making minor improvements in this metric off of a low of a negative 110%. It's improved to negative 90% while still a long ways away from reaching profitability according to this metric. UiPath demonstrating better improvements and better numbers in this regard. Let's get into valuation, and I'm using the forward price to sales ratio, and here's why the forward price to sales ratio is important. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were 185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for 465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. So now that you understand why the forward price to sales is important and why I use this metric, you can see here that according to this metric, C3.ai is much more expensive than UiPath, more than twice as expensive as UiPath in this metric at a forward price to sales of 11.7 compared to a forward price to sales of 4.8 for UiPath. Now, while C3.ai has demonstrated better revenue growth, accelerating revenue growth compared to the decelerating revenue growth for UiPath, all the other metrics, the two other metrics we looked at and everything else I know about these two businesses favors UiPath over C3.ai. So if I had to pick one of these two stocks to buy for 2025, I would pick UiPath. That would be my choice as the better stock to buy for 2025. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.